Hi everyone, welcome to week 6. We're going to be taking a look at 4 different problems that are due this week. Now, even though there's 4 problems and we are covering more chapters, the problems are a little less intense than last week. So I don't think it's going to take you as long to do the homework for this week as it did last week. So just be encouraged by that. Even though you have to do more reading, the problems are a little bit simpler. So let's first start with CP 833 requirement 1. What we're doing in this particular problem is what's called a bank reconciliation. For those of you who do this, it's very similar to balancing your checkbook. A lot of people don't do that these days, but for those of you who do, it's very similar to that. So what we're trying to do, if you notice that in the problem, you're given on the text, page 475 of the textbook, you're given the cash T account, where you see certain transactions that have occurred during the month of March. Okay, and then you're also given a bank statement. And the bank statement is the bank telling the business, this is what we have recorded that has occurred in your account during the month of March. So because of the timing element, some things will occur in the business that haven't yet hit the bank, and some things happen in the bank that haven't yet been recorded in the books. So what we have to do is we have to bring those two together and we have to reconcile them. So the first thing you want to take note of is we're going to have a balance that the bank says that we have as of March 31st, 2017. So you'll notice that that's given to you in the text at the end of the bank statement. It says ending balance for March 31st, 2017. You want to put that amount right in here. Then over on the book side, you're going to be taking a look at the balance, the debit balance that's in the cash T account for March 31st. And again, that's given to you on page 475. So then what we have to do over on the bank side is we have to do we have to add deposits in transit. Now, deposits in transit are those that the business has recorded on their books, but it hasn't yet hit the bank because the statement went out prior to it actually hitting the bank. So the bank statement's not going to reflect the deposit that's shown on the book side or that the business has, because the business made their deposit, recorded in their books, but the bank statement already went out. So the bank doesn't reflect that particular deposit. So what you want to do in order to determine what your deposits in transit are is you want to take a look for any deposits that are in that cash T account that are not on the bank statement. Now, deposits are always going to be listed. Remember, this cash is an asset. It's a T account. It's an asset account, and so therefore, any positives will end up on the debit side. Any negatives on the credit side. So we want to look for deposits in the cash T account those appear on the debit side because they increase the cash account. So you want to take a look and see what deposits are listed on that cash T account that don't show on the bank statement. You're going to add to the balance from March 31st any deposits in transit. And then you're going to come up with a new total there. Then you're going to subtract from that balance any outstanding checks. Now, outstanding checks are those that, again, it shows on the books of the business, but have not yet cleared the bank. They haven't hit that bank statement. So here you're going to be looking for any checks that are written, and those are all on the right side or the credit side of the cash T account, and you're going to be looking for any of those that don't show up on the bank statement, and you're going to be putting those check numbers here and the total of those amounts here, and you're going to be subtracting the outstanding checks from this balance that you had here. And that's going to be your adjusted bank balance. So this is taking into consideration that, hey, the bank says you have this balance as of March 31st, but we need to add deposits that the book side has made, that the business has made into their T account, and we have to subtract out any checks that have been written, just haven't cleared the bank yet. And you're going to come up with a new adjusted bank balance. Now on the book side, we have to also make some entries that don't show up on the book side. And those are things that happen at the bank that have not been recorded on the book side, that the business hasn't recorded. Now, first we want to start with the balance as of March 31st, and that's given to you in the T account on page 475. And then it says we want to add what's called EFTs collections. So those are electronic fund transfers. So some things are deposited automatically into the bank, maybe on a monthly basis. And so they go into the bank, and yet the business hasn't recorded them. They have to wait to get their statement in order to make those entries. So that's what we want to do. We want to record this EFT collection from Hip Hop. And then we're going to subtract any EFT payments. So as a business, you can set up electronic fund transfers so that you have monthly, that you know a certain bill is due every month, and so you just set it up so you don't have to actually write a check. So you set it up as an EFT payment, and that automatically the bank sends out the check to that particular vendor. The problem is you haven't recorded it in your books. You wait until you get the statement, and then you see any of these EFT payments, and you have to subtract those from your book balance. And then any bank charges. Banks charge you to have checking accounts normally, so any charges that the bank applies to your account has to be taken out now on the book side because you haven't recorded them. So after all that is done, you're then going to have an adjusted book balance. Now these adjusted bank balance should be the same as the adjusted book balance. And I will let you know what that balance it is so that you know whether you've gotten it correct. So the bank balance and the book balance should end up to be $52,113. If it does not, you've made an error somewhere here. You either wrote in the wrong balances, or you didn't do your deposits in transit right, or your outstanding checks, or you didn't record these correctly. Okay, so the balance should be $52,113. Now in the second part of this, we then have to do journal entries, record any of these entries that we haven't recorded in the books before. Remember, those are ones that the bank has done for us, the EFTs and the service charges, but we haven't recorded them on the books. So now we have to do that via journal entries. And these are those journal entries that you'll do, and these are the available accounts for the journal entries. And then this is your cash T account. You just want to put in the balance as of March 31st, and then you're going to be putting in those particular debits and credits so that you have a new ending balance, which will be that $52,113. Okay, that is CP 833. Now on to E919. This is out of Chapter 9. Now what we're doing here is we're determining the accounting for uncollectible accounts using what's called the allowance method. And this is the aging of receivables. So what we do here is we have to kind of come up with a target amount that we want in that allowance for bad debts. So we're kind of estimating, based upon previous history, what do we expect to have uncollected, okay? And that's based upon a history. So you'll see that in the 1 to 30 days, those accounts receivable that are 1 to 30 day old, we expect that we're not going to get 0.8% of that 75,000. So here is the balance that's in accounts receivable for that particular number of days, and then this is the percent that we expect to not collect. Okay, so in the 1 to 30 day category, those accounts receivable that have only been in our accounts receivable for 1 to 30 days, we expect that we're not going to get 0.8%. It's a pretty small amount. Now be careful when you're doing your calculation. You want to multiply 75,000 times 0.8%. So if you put that into your calculator, you'd have to multiply it by 0.008. You have to move that decimal 2 places to the left. And you come up with the estimated uncollectible for the 1 to 30 day category. You're going to do the same thing for the 31 to 60 day, the 61 to 90, and the over 90 days. Now you'll notice that the percentage is increasing. And the reason for that is because the older an account gets in accounts receivable, the less likely it is that a business will be able to collect on it. If they've waited that long to pay the bill, then they may very well not pay it. So that's why you see the increase in the percentages. Just be careful when you're multiplying that you do those percentages correctly. When you're done calculating all of these different categories, 1 to 30, 31 to 60, 61 to 90, over 90, you then get a total amount that is expected, that an estimated total uncollectible. Now that amount, whatever it is that you calculate, we now want to come down and we want to record the bad debt expense for December 31st. Now what you want to keep in mind here, This is our estimated amount. Okay, that's our target balance. That's what we want to have in the allowance for bad debts. Now, the problem tells us on page 516 that there is currently in the allowance for bad debts a debit balance for $24,000. Now, this target balance that we're going to be calculating here is what we want the credit balance to be in the allowance for bad debts. So that's important to keep in mind. If the target balance is a credit balance of $25,100 and we currently have a debit balance of, I have to take a look again, a debit balance of $24,000, think of that as kind of like a negative. We're kind of $24,000 in the hole. We have to bring it up to $25,100. So you're going to want to add whatever you calculate here in that target balance. You want to add the you want to add the $24,000 debit balance, because that's going to bring up the amount to the $25,100 that we want to see. So remember, it's currently a debit balance and we have to bring it of $24,000, and we need to bring it up to a credit balance of $25,100. So we need to add those two amounts to put into this debit and this credit amount. Okay? And then this is your T account. You just want to put in what that expense that we calculated with the new balance. And then you're going to have your accounts receivable, $230,000 less that allowance to come up with the new balance sheet amount for accounts receivable. And that's all you do for E919. Then on the third problem, you're going to be doing, it's pretty simple. They're going to have to calculate the bad debt expense using, in this particular case, we're going to be using the allowance method. It's pretty simple. You're going to have two entries. You're going to have an entry on January 31st and an entry on February 15th. The one on January, and these are the journal entries that you'll use in those transactions. So on January 31st, you have to estimate what that bad debt expense is, and it's based upon a percentage of the sales revenue. And so they give that to you, so you just do a simple calculation. And then in the second entry, they tell you that there's one account that has become not due. They know they're not going to collect on it, so you have to write off that particular amount. So this is a pretty simple problem. Then the final problem is depreciation. You're going to be calculating depreciation on a computer and one on office furniture using two different methods. One is a straight line depreciation, the other is double declining. Here are the formulas that you're going to be using. So very simple, you take your cost less your residual value, divide that by the useful life, and these are all given to you, times the number of months divided by 12. So that's your calculation. Thing to keep in mind, number of months, we're only looking at 1 month here. Okay, so don't confuse that. Just 1 month. That's the number you're going to use for that. The double declining balance uses a different formula where you take the cost less accumulated depreciation, and I can tell you that in this particular case the accumulated depreciation is 0, so it's just the cost, and then you multiply by 2, and then 1 divided by the useful life times 1 over 12, and that's because it's just 1 month's worth of depreciation. Now whatever you calculate in both of those, you're going to be transferring over here to your journal entry. And again, the journal entry for depreciation is always the same. You're going to debit depreciation expense and you're going to credit accumulated depreciation. Debit depreciation expense, credit accumulated depreciation. One for the computer, one for the office furniture. And you're going to be doing that. You're going to be putting the amounts that you calculated in requirement 1. Okay, I think that is all I have to say about these problems. If you have any questions, give me a call. Number 602-639-7378. Thanks so much, everybody.